Chapter 7, Company Analysis, Business and Governance. Learning Objectives. After studying this chapter, you should know about role of company analysis, different kinds of business models, pricing power and sustainability of pricing power, critical success factors of a company, competitive advantages and differentiation, SWOT analysis, how to understand quality of management and governance model of a company, why it is important to understand the risks to a business, importance of knowing history of credit rating of a company and changes over time, ESG framework for company analysis, role of company analysis in fundamental research. As mentioned in Chapter 4, investing in shares involve careful and thorough analysis of a company's business. However, a company is only a micro-unit in its industry and in turn in the economy. Their fortunes will be driven by external conditions including overall macroeconomic factors and industry-specific factors. Although these external factors affect every company in the industry, how an individual company performs also depend a lot on company-specific factors. Thus, once an analyst understands how an economy is performing and how a particular industry is likely to prosper, they have to find answers to company-specific questions, which include the following. 1. What is the company's business? As mentioned in Section 6.2, this question drives our definition of the industry. Thus, analysts should understand this at the very beginning. 2. What is the company's business model? 3. Does the company enjoy any competitive advantage compared to its competitors? 4. Does the company have the necessary capability to exploit opportunities and to withstand any threats? 5. Is the company management competent enough to identify and execute the appropriate strategy? 6. Does the management have a vision for the company's future and are they able to provide visibility into the expected short-term performance and long-term goals? 7. Does the company have the necessary governance structure that the board and management will act in the best interest of the company and its shareholders? 8. Are such governance structures properly implemented and executed? As an analyst tries to find answers to these questions, several follow-up questions may arise to understand the company in greater detail. Analysts should ensure that they go to the depth to find the relevant answers rather than accept superficial answers. Although many of the questions listed above are qualitative in nature, analysts should try to obtain the necessary data that substantiates their findings. Understand business and business models. Equity investing is all about part ownership in a business. Therefore, it is important to understand the business or business model of the company before investing in it. Accordingly, the starting point of qualitative research on any business has to be questions such as, what does the company do and how does it do? Who are the customers and why do customers buy those products and services? How does the company serve these customers? Almost all successful fund managers are never tired of repeating this thought that one must invest only in such firms where one understands the business. In the checklist for research, this is one of the most prominent questions. Do I understand business? No analyst should move to the next question if she can't address what a company does in line with preciseness and clarity. There are over 4,000 companies listed and active on Indian exchanges. It is not possible to track and understand all of them. Investors should consider buying shares of a few companies they understand rather than investing in a number of companies they don't understand. Quoting Warren Buffett, wide diversification is only required when investors do not understand what they are doing. Further, each sector has its own unique parameters for valuation. For the retail sector, footfalls and same-store sales, SSS, are important parameters, whereas for banking, it is net interest income, NII/net interest margin, NIM. For telecom, it is average revenue per user, ARPU, and for hotels, it is average room tariffs, etc. Analysts must possess an in-depth knowledge of the sectors while researching companies. Further, each company will have its unique way of doing business. The efficiency with which products and services are produced and delivered to customers may vary from one business to another and will significantly impact its earnings. Therefore, it becomes imperative for analysts to understand the entire business model of the companies. It is relevant to quote management guru Dr. Gary Hamel, competition in the marketplace is not between products and services but between the business models of the competing companies. Pricing power and sustainability of this power. A key factor to look while studying the business of a company is its pricing power, as that would help a company maintain and grow its profit margin. Pricing power refers to a company's ability to independently determine and charge the price of its products. Companies with strong pricing power would be able to pass on any escalation in input cost to its customers. They can also increase their prices when demand is strong and thus grow their margins. Most often, pricing power is driven by industry factors that affect all companies in the industry. These factors include the competition intensity in the industry, the price elasticity of the product, and the level of commoditization of the product. However, there are certain company-specific factors that position a company differently from its peers. Company-specific factors include its natural leadership position in the industry, brand affinity among customers, and its cost base. For instance, for several petrochemical products, smaller players in the industry price their product based on prices set by Reliance Industries Limited, RIL, as it is seen as the natural industry leader. This allows RIL the ability to independently price their product. Similarly, a company with strong brand perception/brand loyalty is likely to be able to price their product independently. Low-cost base helps a company to keep their pricing low without having to worry about competitors following suit, as reducing price may not be financially viable for the latter who have a higher cost base. Studying this is very critical to understand which industries are likely to do well and which player in an industry is likely to outperform its peers. Competitive advantages/points of differentiation over the competitors. In every industry, some players do better than others. Therefore, as an analyst tries to understand how a particular company is likely to perform in the future, they need to understand how the company is likely to perform vis-a-vis its competitors in the industry. The differentiating factors for a company compared to its competitors can be categorized into 3 areas. 1. Differentiation in product features. 2. Competitive pricing driven by operational efficiency. 3. Better execution. 1. Product differentiation. One way in which a company can outdo its competition is by incorporating better features in products that would appeal to its target customer group. The differentiating feature can be in terms of product quality or its functionality. This would help them create a value proposition for their customers and is likely to help the company attract more customers than its competitors. In order to be able to execute this strategy, a company should have a strong research and development (R&D) team and a culture of innovation. In a highly competitive industry where many players are constantly engaged in introducing new products, the leadership position may keep shifting from one player to another. However, those with strong innovation will be able to outperform those who lag in that department. An analyst, therefore, needs to compare the products of a company with those of its competitors to see if they have offered better features. It is important for the analyst to look at the data that can substantiate the advantage and not get carried away by superficial marketing claims. 2. Competitive pricing. Another way a company can compete better with its competitors is by pricing its product competitively. If customers perceive products of many companies to be similar in nature, they are likely to prefer products that are priced at the lower end as compared to those that are priced at a higher end. However, competing by keeping the prices low is sustainable only if the company has a low-cost advantage. Otherwise, competitors would be able to mimic the company's strategy and reduce their price as well. However, if a company's cost is lower than other players, then it can sustain the low price advantage as competitors would not be able to sustain a price that is lower than its cost. Price differentiations are easy to spot in an industry that produces highly commoditized products. However, in other industries, it becomes difficult. For instance, if an analyst were to compare Toyota Camry with Honda Civic, the latter might be less expensive, but the former is likely to have more product features. Therefore, the two may not be a like-for-like comparison. In such cases, analysts can try and identify which products offer the end customer better value for money. This can be achieved through primary research or by analyzing the performance of similar models in the past. 3. Execution. Another very critical factor that helps a company do better than the competition is the company's ability to execute better. Companies that manage to communicate better with their customers or execute a better sales strategy through a focused approach can do better than their competitors. Execution capabilities can be studied by looking at the past track record of the company as well as its management. Strengths, weaknesses, opportunities, and threats SWOT analysis. External environments constantly change. These changes provide new opportunities and the same also create new challenges. When a new opportunity is presented, companies that are well-positioned to take advantage of that opportunity utilize such opportunities and prosper while others miss out. Similarly, when a new challenge or threat emerges, companies with strong fundamentals survive such challenges. On the other hand, companies that are vulnerable may perish in the face of such a challenge. Understanding these factors will help an analyst evaluate a company's growth potential as well as its risk tolerance. For example, the COVID-19 pandemic created major disruptions in business, with several businesses being locked down. This is a major threat. Companies with weak financial position are extremely vulnerable to the lockdown. However, companies with strong financial position might be able to survive the lockdown. SWOT analysis is one of the popular frameworks that can help an analyst evaluate business fundamentals. SWOT is an acronym for strengths, weaknesses, opportunities, and threats. Strengths and weaknesses are internal to the company, while opportunities and threats emanate from external conditions. Analysts can approach SWOT from two sides. 1. Identify the strengths and weaknesses first, and then identify what opportunities they can exploit and what are the threats for which the company is vulnerable. 2. Alternatively, the analyst can identify the opportunities and threats first and then identify what strengths of the company will help them exploit the opportunities and what weaknesses make them vulnerable to the external threats. The first approach is suitable for companies when they are deciding their strategy. However, for an external observer like an equity analyst, the second is more suitable. Further, in a typical EIC framework, as the analysts study the external conditions first and then study the company, the second approach falls more in the logical order of things. The 4 aspects are detailed below. Strengths. Strengths refer to internal capabilities of the company that allow it to exploit external opportunities and withstand threats. Strengths of a company include the following: strong financial position, highly valuable intellectual properties, low customer concentration, low cost or high margins, support from parent company or government, and strong execution capability and track record. Weaknesses. Weaknesses refer to internal issues that make the company vulnerable to external events or prevent it from exploiting an available opportunity. Sources of weakness for a company include the following: weak financial position, high fixed cost, low margins that can easily turn negative in case of a slowdown, higher customer concentration, significant legal cases that can distract the company's focus or that have potential to cause losses, lack of experience in executing a particular strategy or in operating in a particular environment. While identifying strengths and weaknesses, analysts should focus on those strengths or weaknesses that are related to the opportunities and threats. For example, lack of experience in self-driving cars can be a weakness for an Indian automobile company if there are catalysts in the industry that are likely to fuel the growth of such cars. However, if no such opportunity is likely to exist in the foreseeable future, then it may still be a weakness but not of immediate relevance. Similarly, a sequential decline in revenue or profit is not a weakness unless it is likely to make the company lose out on a new business opportunity or make it ineligible for a loan or create any other vulnerability. Although SWOT analysis is a very good framework, analysts should be wary that, as an outsider, they may not be able to identify all the strengths and weaknesses of a company. For instance, no company would publicly disclose the clout they have in the government or the strength of their lobby. Similarly, if a company has been intentionally hiding its financial woes through creative accounting, it is not easy for outsiders to identify such a fraud. Opportunities. Opportunities are created through external environment. Opportunities come in myriad ways, and hence it is difficult to list all of them. However, the following can be an indicative list of opportunities. Certain events can create opportunities for faster growth. Occasionally, some event occurs that creates an inflection point in the growth curve of one or more industries. For example, if a new battery technology becomes available, it can create faster growth opportunities for the electric vehicle segment. Similarly, post-COVID-19, some companies across the globe have shown interest to move their production and procurement outside of China. This gives an opportunity to various manufacturing companies across industries outside of China to grow their business fast. New business opportunities may arise on account of technological advancement, change in regulation, or any such factor. For instance, when the Companies Act 2013 was implemented, many consulting firms got an opportunity to offer services to implement the provisions of the new law. Y2K problem created opportunities for various Indian IT service providers to offer maintenance and upgradation services to their clients. Companies may also get opportunities to expand geographical footprint. Some geographical locations may be out of bounds for some businesses either due to strong capital control regulations or per market opportunities. However, when these conditions change, it presents an opportunity to expand into new territory. Adverse market conditions can throw opportunities for consolidation. For example, when Jet Airways suspended its operations in April 2019, it created opportunities for other airlines to increase their market share in the industry. Similarly, in recessionary economic conditions, lower price of shares and low interest rates can provide opportunity for stronger players to acquire other players in the industry. Threats. Threats are essentially risk that comes from external environment. While an analyst assesses the threat, it is very important to distinguish threats coming from external environment to risks on account of internal situation. For example, high customer concentration is a risk for a company. However, since it is internal to the company, it is a weakness and not a threat. Threats also come in myriad ways. In fact, events that create opportunity for one industry may create risk for another. Some of the possible sources of threat include the following. Economic recession can cause a significant decline in the fortunes of many businesses. Regulatory headwinds can also create a threat. For example, if the government mulls banning single-use plastics, that can act as a threat for manufacturers of such products. Technological disruptions that favor one industry can be a threat to others. For example, while artificial intelligence creates many new opportunities, it is a threat for the BPO industry that is involved in doing repetitive tasks. Deregulation of an industry can remove entry barriers and can create threat of increased competition. For example, when the Reserve Bank of India decided to offer on-tap license to new banks, it created risk of increased competition for existing banks. While identifying threats and weaknesses, it is important to focus on such opportunities and threats that have reasonable probability of occurring. Although there is always a risk of black swan event such as COVID-19 crisis, it may not be prudent to include all possible threats as the list would be too long to be useful. Quality of management and governance structure. Companies are organizations where ownership is separated from the management. While shareholders own the company, the day-to-day management of the company is handled by a separate management team comprising the CEO or managing director and others below them. The management team reports to the board of directors who are appointed by the shareholders. This separation in management and ownership creates an agency risk. In other words, the shareholders rely on management to work in the interest of the company and the shareholders. However, there is a risk that the management may pursue their personal interests at the cost of shareholders or may not be capable enough to effectively run the organization. Therefore, one of the critical areas that an analyst needs to evaluate during a company analysis is the competency and integrity of the management and board. However, this is an extremely challenging task. While analyzing the competency is challenging, analyzing integrity is almost impossible. Unless there is reasonable evidence, it is inappropriate to cast aspersions on anyone's integrity. Therefore, analysts should instead focus on the corporate governance structure to see if it has the necessary controls in place to prevent inappropriate governance actions. Evaluating management competency. The top management of a company typically includes the CEO, CFO, COO, and other C-level officers. Assessing their competency is a challenging task for an analyst. The top management of the company typically has several years of experience and comes from varied disciplines. It is least likely that an analyst would possess the necessary skills to assess the competency of all of them. However, analysts can try to find answers to the following questions to be able to evaluate the top management. A. Do the members of the top management team possess the necessary educational qualifications in the relevant discipline? Although educational qualification is often looked at, it does not necessarily provide a definitive answer on management competency, as there are many other factors that affect competency. B. How many years of experience do they have? Management with higher number of years of experience is likely to have faced many business challenges in the past. Such experience is likely to help them tackle future challenges relatively better than an inexperienced management team. C. If any of the top management team has been in such a role for several years in any of the companies, how did those companies perform during the years in which they were in a senior role? One of the critical data points that can provide insight on management competency can be obtained by looking at their past track record in a senior position in the same or in another company. However, this also may not provide a definitive answer, as the performance of a company depends on many factors, including external conditions and the role of other managers. D. How long has the top management team been associated with the company under study, and how has the company performed during their tenure? It is not necessary that an executive who performed extremely well in one company deliver similar results in another company. However, if the top management has been associated with the current company for a long time and has delivered results, then it is relatively more likely that they may be able to continue similar level of performance. E. Does the management have a vision on long-term goals and the strategic direction of the company? Shareholder value is created over a long term. Thus, a competent management team should be able to provide a vision for the long-term goals of the company and what kind of strategic direction the company intends to follow. However, it does not necessarily mean that management should inform about all their strategies to the shareholders, as they may not want competitors to know the complete details of those strategies. F. Do the members of the top management team have necessary experience in executing the current strategy of the company? It is not just important for the management to be competent, but they also need to be competent in executing the current strategy. For example, if a company is currently focusing on innovation as a strategy, it is preferable to have someone with prior experience in successfully leading several research projects in the top management. G. Does the company give guidance on expected near-term performance and whether they typically achieve such guidance? If a management team consistently provides such guidance and has a track record of consistently meeting or exceeding them, it is likely that they have better control on the business. H. Has the management ensured timely regulatory compliance on a regular basis? A management that is in complete control of affairs should be able to comply with all regulatory requirements well within time. When a management fails to comply with them, it perhaps indicates that they are not in control. Further, failure to meet regulatory compliance requirements is also a red flag on the integrity of the management. I. Is there sufficient delegation in the decision-making process? If the decision-making process is well delegated and is fairly broad-based, it can ensure continuity even when there is churn in top management. On the other hand, if the decision-making is highly concentrated, then it creates keen risk, as churn in top management can derail the decision-making process. J. Does the company have a succession plan for its top management? In line with the previous point, a proper succession management plan ensures continuity even if there is a churn in top management. Lack of succession planning can create trouble if the current management has to be replaced for any reason whatsoever. Evaluating corporate governance. Corporate governance refers to the rules, processes, and procedures that are followed in the management and operations of a firm. The objective of a good corporate governance standard is to ensure that the company is run well to take care of all the stakeholders, including shareholders, lenders, employees, suppliers, and customers. Regulatory standards on corporate governance focus on protection of investors with additional focus on minority or non-promoter shareholders. In India, SEBI's Clause 49 of Listing Agreement sets the corporate governance standards. It is important to understand that the regulatory standards are the minimum standards a company must follow. Some companies may set higher standards for themselves. A company following strong corporate governance standards would be able to prevent agency risk or, at the very least, detect and rectify them in time. An analyst can look at the following to ascertain the corporate governance standards of the company. 1. Board composition. The directors of a company can include independent directors, non-executive directors who are not part of management but not independent, either, and executive directors. For the sake of strong corporate governance standards, majority of the board should comprise of independent directors. Currently, SEBI regulation stipulates that independent directors should constitute at least 50% of the board if the chairman is an executive director. In all other cases, it requires 1/3 of the board to be comprised of independent directors. 2. Separation of board chairman's role and role of MD and CEO. The CEO is answerable to the board of directors. For effective corporate governance, it is critical that the chairman position should not be occupied by the CEO or the managing director of the company. Currently, SEBI mandates this requirement for the top 1,000 listed companies. For companies where it is applicable, it is also mandatory that the CEO should not be from the promoter group. 3. Nomination committee for independent directors. The degree of independence of independent directors is likely to be high if the company executives do not have a role in their appointment. Therefore, the nomination committee to appoint independent directors should ideally consist exclusively of independent directors alone. 4. Auditor fees. Audit independence is one of the very critical aspects of corporate governance. For an auditor to be able to be truly and completely independent, it is necessary that they should not be overly dependent on the fees earned from a given corporate entity or a business group. Accordingly, it is important to check if the auditor's remuneration for all the services they provide to the group or entity is less than 10% of their overall income. 5. Auditor rotation. It is necessary that auditors are rotated once in 5 years. This would ensure that there is an opportunity to find any facts concealed by the management in connivance with an auditor. 6. Audit committee composition. The audit committee is responsible for reviewing the financial statements of the company and for nominating the auditors. Ideally, the audit committee should comprise entirely of independent directors. SEBI regulation requires at least 2/3 of the members to be independent. 7. Related party transactions. It is important to prevent unscrupulous related party transactions that can enrich the promoter group or other majority shareholders at the cost of minority shareholders. Ideally, all material related party transactions should be presented to the audit committee for pre-approval. Currently, the SEBI regulation does not mandate pre-approval but requires placement of all related party transactions in front of the audit committee. If the transaction is not on an arm's-length basis, then the regulation also requires that the company should provide justification for the same. 8. Remuneration committee composition. The remuneration committee decides the remuneration of directors and senior management. Ideally, the committee should comprise entirely of independent directors. SEBI regulation currently stipulates that all members should be non-executive directors and the chairman of the committee should be an independent director. 9. Remuneration of independent directors. It is important that all the income that an independent director earns from a company for all assignments are thoroughly disclosed so that shareholders can evaluate the true degree of independence of such directors. The SEBI regulation has several other provisions related to the meeting of directors, various committees, and several other aspects. Good corporate governance practice should encompass all the above. However, it would be preferable if the companies follow even stronger corporate governance practices than those mandated by the regulator. Promoter holdings. The concept of promoter is somewhat unique to India. The legal definition of promoter really does not define their role. The law simply states that a promoter is an investor who has been named or is identified as a promoter. Practically, the promoter group of shareholders typically comprise of those who were part of the initial founding of the company or are part of the group of controlling shareholders. As far as other investors are concerned, having a strong promoter shareholder has some positives and some negatives. A promoter group of shareholders is likely to have a higher level of control over the management. This, in turn, increases the likelihood of management acting in the best interest of shareholders. On the other hand, their influence over management also creates risk for minority shareholders as promoter group may influence management to take certain actions, such as related party transactions. That may benefit the promoter group at the cost of minority shareholders. Since promoters have a significant role in a company, analysts should also focus on the shareholding they have and the changes in their shareholding. When promoters need funds, many a time they may choose to pledge their shareholdings rather than sell them. When promoters pledge their shares as collateral, lenders apply a haircut on the market price towards the margin and lend money. The haircut helps the lenders to ensure the value of collateral is adequate even if the price of an asset decreases to a certain degree. Pledging of shares may be done by promoters as a way of raising funds in their normal course and thus does not necessarily signal any concern related to corporate governance or business fundamentals. However, analysts should look at whether the amount of such pledged shares is high or low. High amount of pledged shares can aggravate the market risk in the event of a fall in the prices of such shares. This is because such a fall in price reduces or eliminates the margin for the lenders who may then be forced to liquidate the shares. And sudden liquidation of a sizable number of shares would likely create a further downward pressure on the underlying share price. Risks in the business. Promoters love to talk of the grand future they dream of and visualize. Very rarely would they talk about the risks associated with the journey of converting their dream into a reality. For example, borrowing from the international market at low rates looks attractive, however, adding the angle of currency risk to the discussion turns the whole discussion on its head. Entrepreneurs are, by nature, risk-takers and have the psychological ability to bear shocks. Rupert Murdoch failed thrice before he successfully created the Star Empire. Steve Jobs was thrown out of Apple, his own company, and later was called back. In the meantime, he started another successful venture. While businessmen would be able to bear these risks, not all investors would. There are risks in every business which may range from business aspects to operational aspects to execution aspects and others. The risks may be apparent and known, or they may be unknown. Analysts should focus a lot on the risk aspects in various dimensions of the businesses. They should continuously ask the question, what could go wrong in the business? If promoters state that nothing could go wrong in the business, clearly they fall into the category of people who don't know that they don't know. These types of promoters need to be avoided. A good businessman would always have cognizance of the risks in the business and the steps that need to be taken to protect the business from their effects. History of credit rating. Credit rating refers to the rating of the ability of a borrower to service its debt-related obligations. These ratings, which are provided by a credit rating agency, are issued at issuer level as well as at individual debt levels. Further, separate ratings are provided for short-term and for long-term. Although credit rating pertains to debt, it is also of relevance to equity investors, as a company can provide returns to equity investors only if the lenders are serviced first. Thus, credit rating provides an investor with the level of financial risk involved and can thus drive the return expectations of investors. Further, going through the historical evolution of credit rating of the company can also provide perspectives on how the management reacts to external feedback. Typically, credit rating reports specify what are the factors that have led the rating agency to conclude on a particular rating. It also specifies what the rating agency considers as key concerns. If a company has worked on such concern areas, it indicates that the management of the company has been very responsive to external feedback. Reading through historical credit ratings and how the concerns have changed or otherwise from one report to the next can provide the information for obtaining such insights. ESG framework for company analysis. Most investors focus on the profit-generating ability of a business to make investment decisions. However, over the last few years, the societal discussions about companies and businesses have also started focusing on sustainable development and corporate social responsibility. This has given traction to investment theme that is focused on environment, social, and corporate governance (ESG). Initially, this framework was used by a handful of impact investors. But this framework has gradually gained traction as this framework also provides commercial value. Under this framework, investors evaluate companies based on these criteria. 1. How does the company's activities affect the environment? Companies with low carbon emissions and low contributions to pollution rank better than others. 2. What are the activities that the company performs in terms of social development? This includes focus on human rights, gender equality, and many such social factors. Companies that contribute more to these factors rank better than others. 3. The last criteria focus on corporate governance standard followed by the company. ESG investors use the ESG filter to shortlist their potential investments. Once shortlisted, the stock does not become an automatic investment. Investors perform all the other regular analysis to identify suitable investment. Although the ESG framework appears to be more focused on ethical criteria than financial criteria, the proponents of the framework cite several financial advantages that can accrue to companies following the ESG framework. 1. Companies focused on environment face minimum disruption on account of regulatory intervention of environmental activism. 2. Companies working towards social cause generate positive recall value in the society, which can make it easy for them to recruit employees and attract customers. 3. Sustainable production process can lead to less costs on account of power consumption or water usage. 4. Strong corporate governance practice reduces risk perception and, in turn, reduces the cost of capital for that organization. Equity analysts can include discussion on ESG parameters so that it can guide investors who care for ESG factors. The Securities and Exchange Board of India (SEBI) has proposed strengthening regulations on environmental, social, and governance disclosures by listed entities to enhance their credibility and has named the top 1,000 listed companies to make ESG disclosures as per the Business Responsibility and Sustainability Report (BRSR). Parameters from FY 2023. This initiative will bring more transparency as required for the ESG analysis and data points needed for ESG-based investing. In FY22, more than 175 companies voluntarily reported on the BRSR framework. Sources of information for analysis. There are multiple sources of information on a company. Some of them are defined below. In addition, there are various paid and free databases which can be used by analysts to analyze companies. Annual or quarterly reports. Most easily available, reliable, and consistent source of information. Conference call transcripts. Investor relations or company presentations. Management interviews on the internet. Company website. Ministry of Corporate Affairs website. Research report from credit rating companies. Research report from various other sources, media reports. Parent company's annual report and website. Competitors' websites, including international competitors. Print media reports on companies. Discussion with suppliers, vendors, consumers, and competitors. BRS, our report for ESG disclosures.